Hello, this is video 4 of chapter 7. We were on this slide last time we were together in video 3, and we were talking about who does inflation benefit. And I would like to recap a little bit. Inflation benefits those who own real estate, who own TIPS, inflation index securities. They can be notes, they can be bills, they can be bonds that earn an interest that happens to be tagged to the inflation rate. So when the inflation rate drops, the interest it earns drops. But since in this case the inflation rate is rising, well, then the interest that it pays also rises automatically, and you haven't lifted a finger. But these are very safe investments, therefore they do not outdo investing in the stock market. And I make a point about that in various works, including the exercise you'll be submitting for this chapter. Negative real interest. When it's paid, it also benefits you, which means you're getting a loan, but you're returning it worth less. So instead of you paying to borrow, the bank is paying you to borrow. That's what a negative interest rate means if you are paying it and you're the borrower. If you're the lender, you're actually earning the interest rate. And in that case, you want to earn greater than the inflation rate, because what you're trying to achieve here is you want the money coming back to you worth more than when you lent it out, because in this case the shoe is on the other foot. So if it is a positive real interest rate when it is earned, then that is going to be beneficial to you as well. It's amazing the things I only notice when I am actually talking to you about this stuff. And then here, getting real raises, and that means you get a raise, but the percentage that you are getting has to exceed the inflation rate within that period, which means usually a year, because most of us get our raises once a year. Some people it's a little bit different, but if you want to know if you got a good raise, look up the inflation rate in current times and compare them, and then you'll see if you have a positive or if you have a negative real raise. Okay. Now, our next point here is to talk about demand pull inflation versus cost push inflation, and the last point is hyperinflation. Let's see how far we can get in this video. What is demand pull inflation? First thing I want you to notice is the language. Economists are not creative. There's an upside to not being creative, and that is the titles reveal to you quite a bit about the concept. When you're pulling something, the force is with you, right? It is a voluntary action. You're deciding to pull the prices up. You, as in the buyer, because the minute you see demand, you always think of the buyer. This is from chapter 3. They go hand in hand. So demand pull inflation, in a nutshell, means the buyers in general, have more income to spend, and therefore they are chasing too few goods with too many dollars. See down here, too many dollars chasing too few goods. It's like too many dollars spent chasing too few goods that are available on the market. The word aggregate. Aggregate means total. So when we say aggregate demand, we're talking about all of the demand in an economy. So just like, you know how there are like millions of supply curves and millions of demand curves, because every product that has anything with a price has a demand and a supply curve. When you lump them all together, they become an aggregate. There can only be one total. If you have a receipt, how many totals are on the receipt? One. It can only be one. So there's one total demand for an economy, and there's one total supply for the economy. And they're called aggregate demand and aggregate supply. Now look with me at this graph. If this were a demand curve, you would have here the price on the Y, and you would have quantity demanded on the X. But in this case, because we're discussing aggregate demand and aggregate supply, we have the price level on the Y, and we have the real GDP on the X, and we understand in this case that it is real GDP purchased if we're talking about demand, and real GDP produced or provided when we're talking about the supply curve. So what's happening in this economy is, first, the prices were, this is how much is getting bought in total at Y1, and this is how much the prices are when this much was being bought, and the price level, which is the inflation rate, is lower. But when the inflation rate here is higher at this point, so what this is actually showing you is due to various reasons, probably an increase in income, like we said. There's been an increase in income, that's variable number 3. It causes a shift in the aggregate demand curve, and this shift establishes more buying at actually higher inflation. So in this case, what's causing the shift in the economy is more total buying, causing prices, dragging prices up with it. That is demand pull inflation. Demand pull inflation occurs when aggregate demand grows at an unsustainable rate, leading to a positive output. The actual GDP is bigger than the potential. Remember that GDP gap we talked about before? When there is excess demand, producers can raise their prices and thereby achieve bigger profit margins. And the last point here is that demand pull inflation is most likely when there is full employment of resources, when aggregate supply is inelastic. We don't want to worry too much about this, or maybe you will when you come visit me in microeconomics, and then we will go over inelasticity of supply, elasticity of demand, and all that jazz. But for now, it's enough to say that demand pull inflation means employment is strong, the economy is robust, there is a lot of income, and too much percentage of that income is being spent. So much so that it is outrunning how much there is available. It's kind of like at an auction when there are lots of people with money, they end up bidding high. I mean, this is what makes a difference for whether you have a successful auction or not. If the people who show up are strapped, that's a problem, because then their bids are very low and the highest bidder is not all that much. But in this case, it's the opposite, right? The highest bidding is actually driving prices up. And this is what's happening in gentrified communities, where you see a community where people, for instance, from another wealthy area are selling their houses, like places like Washington or New York or California, and then they move into areas like New Mexico, Santa Fe, New Mexico, or they move to Maricopa County in Arizona, and then, or Austin, Texas, and what they do is they fuel the prices because they're bringing with them so much money, they're willing to pay more than the locals for the real estate, and that prices the locals out, and that's what gentrification is about, and that would be due to a type of demand pull inflation. Not enough houses on the market, and yet a lot of wealthy people coming to outbid each other for them. Now we also have cost push inflation. Cost push, look at the language again. Pushing isn't very pleasant, and it's called cost pushing because in this case the prices are being pushed on you instead of you as a consumer like pulling the prices with you with the mighty wallet of yours that is now fat and happy. In this case the consumer is having prices pushed on them. I really want you to look at the current situation. The current situation with inflation being ridiculously high for us in 2022 is not due to political policy of any kind. What's happening is the supply chain interruptions and the scarcity of certain goods and the wars that are breaking out around the world and COVID and all the people that have to take time off from work or the Great Resignation. It's multiple reasons that are adding up to not enough goods and services, whether they're in their intermediate form, raw form, or finished final good form. All of that is causing the seller to push the prices down onto the consumer. And this is why from week to week, sometimes we're shocked. We're like, wait a minute, a dozen eggs just 2 weeks ago were a whole $1 lower. What's happening, right? That's because the prices are rising so rapidly that the seller is saying, I don't want to be the one to absorb all the costs. I'm going to pass at least some of it onto you. Sometimes I'm passing all of it onto you. Sometimes I'm passing it all and then some, like what's happening with oil companies that right now are facing all kinds of accusations of greed and avarice. Now look at this with me here. We're looking at the economy as a whole, so we're still talking about aggregate supply and we're still talking about aggregate demand. If this were a supply curve, a demand curve, generic ones, the price would be on the Y and the quantity would be on the X, and the quantity supplied for the supply one and the quantity demanded for the demand curve. But in this case, we're talking about aggregate supply and aggregate demand, therefore our variables, all language that's important. On the Y, it's the price level, in other words, inflation. On the X, it's the real GDP. For demand, it's real GDP bought. For supply, it is real GDP provided, produced, made available, whatever language inventory do you want to use, as long as we stick with the concepts. Aggregate supply is pushing inflation up due to rising costs. This is predominantly what's going on. When they're pushing them onto the buyer who is pretty uncomfortable with that situation. So this is a scarier type of inflation. This is the kind of inflation that we truly get concerned about. Now, when we look at, actually, let's talk about that a little bit. When you couple when we begin to worry about stagflation, it is the kind of unemployment is too high, but cost push inflation is very much alive. I think I'll make this point to you again in the future, but what we are seeing right now is low unemployment, but cost push inflation that's getting to be too high. We have some demand pull inflation, but we have more cost push inflation. If the unemployment rate breaches that 4.5% or 5%, we're going to really get concerned about the worst case scenario, but we're not there yet, and hopefully we don't even have to get there. But to go back to here a little bit, look what's happening on this graph. The demand isn't doing anything. That's why you have only one curve. That means there's been no shift in the aggregate demand curve. But there definitely has been a shift upwardly here from the aggregate supply curve. Here's one, here's two. So look what happened. Before the shift, the economy was producing this much at Y1, and it is at these prices, the price level 1 right here. But because there is a leftward shift, this is kind of like a reduction. I know it looks up, but it's up and left. And you know this because what we're seeing down here is total production has shrunk. So this economy is producing less, even though the inflation they're causing the inflation to actually be higher. Remember, less supply makes prices higher. More demand also makes prices higher. In this case, it's not the demand, it's simply less supply. So it's a leftward shift. It's kind of weird when we say leftward, but it just looks up, but it is leftward from down here. You can see that it's leftward when you look at the X. The real GDP went from Y1 to Y2. This is definitely a leftward shift. That's why X is the most important one. That's why it is your independent variable. So let's look a little bit at what it means. Cost push inflation occurs when firms respond to rising costs by increasing their prices to protect profit margins, and they are caused by rising units of labor. In the US, we spell it without a U, but I love this one so much. So we're looking at, this is where how much we're paying our workers is becoming higher. We're seeing something that's happening now with more signing on bonuses or greater raises, more frequent ones. Higher prices for important components and raw materials. If you go back to the law of supply, we have something called prices of related goods, right? Or we have prices of resource prices. So when resource prices are higher, a depreciation in the exchange rate. So if the currency is weaker, it can make it where it is more expensive to import the goods and services, and then the consumer has to pay the higher prices passed on by the seller. An increase in business taxes. It is possible that if businesses have to pay more in taxes, they pass on some of this increase to the consumer as well. So these are causations right here. They're really so nice to have. There's I'm going to do a side-by-side comparison in our next video, and I'm going to talk about high inflation, and that's pretty much what's left. So one more video.